Let's go.
Welcome, everyone, to this special episode of Zephyr's Adjusted for Risk podcast. I am Ryan Nauman, the market strategist here at Zephyr. We are recording this special episode on the morning of October 17th, as it's been a very interesting week in markets. Cockroaches made headlines. We have bankruptcies with, First Brands Group and Tricolor Holdings. Then yesterday, regional banks Zions and Western Alliance banks disclosed bad loans, including allegations of fraud, resulting in treasury yields falling and gold climbing. So we have a lot to discuss, and I have on the perfect guest to help me unpack it all. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I shared the stage with my next guest last week at last week's Super Return North America event in Miami, where he covered all things private markets, but specifically private credit. Today, we're going to cover this week's events, also talk about the health of private credit. And with that, I'd like to give a very warm welcome to Sean Kelly Rand. Sean is a managing partner at RD Advisors. Sean, thank you so much for coming on the show on such short notice. It's an honor to have you on, sharing the stage again with you. I'm really excited about this conversation. It's going to be a good one. Can you please tell us a little bit more about yourself and RD Advisors?
Yeah, so my name is Sean Kelly Rand, managing partner at RD Advisors, one of the co-founders here. Bit of my background and why is this interesting? So we were just back on the stage, last week at Super Return on the real estate conference, talking about real estate private credit and hybrid structures, and going back to when I was just getting out of business school at Lehman Brothers. Why is this timely? How did we get on here? Bit of my background, I grew up in the real estate kind of field and with my family and construction and real estate brokerage. And then I ended up going into real estate finance and went in at graduate business school in 2006, started slightly before that in 2005, but caught that run up. And of course, where did I go? I went to the captain of all credit markets. If you're going to go into real estate, is driven by the bond markets. And then who runs the bond markets in the US back in 2006, 2007? The king of the bond markets, in my humble opinion, was Lehman Brothers. And so if you're going anywhere and you want to be in real estate, it's got to be the credit shop. Where was the credit shop to be? It was Lehman Brothers. And that's where I went. It was my first choice. And I was just chatting yesterday with somebody who was an ex-Goldman guy. And I said, I turned down Goldman. Goldman invited me for final rounds, fly me over to London. And I said, nope, I'm taking this offer at Lehman. I was dead set on Lehman as my first choice. And what's interesting now is we're talking about this now, and I just did the genesis of this podcast is I do a bit of posting on LinkedIn, and I posted about, cockroaches in the credit market, right? So when you see one, there's more. And that's target back to what we were seeing in kind of 2006, 2007, right? When all of a sudden we're going back to last financial crisis and saying, hey, some of these things are popping up. So that's how we got here. Where I came from was the real estate into the real estate private equity and private credit markets. What do I do today? I run a small real estate private credit fund in Boston. Why did we set it up? We set it up on the premise of what happened in the global financial crisis, where everything fell apart. And we set this credit fund up for myself and a family office, which is our partners, basically to weather through this type of storm that we see on the horizon, right? With the idea that we want to be in senior debt, we want to be senior secured, and we want to have something that allows us to sleep well at night going through the next crisis. And so that's what we've done, is set up a short-term senior credit fund with very low back leverage and providing liquidity when no liquidity is available.
Yeah. Fantastic, Sean. And I love your experience back in 2006 when you made that decision to go with Lehman Brothers. Did you have any idea what was about to happen? Thinking now just the history that you have, that experience that you can fall back upon, and just the wild ride it must have been.
Yeah. In some funny sense, people talk about 2006 and 2005, and they forget, and at least in the real estate market, back 20 years before, right? So my mother was a real estate agent, and she sold foreclosures in the late 90s. That was the real. And then you go back before that, and you had the RTC around the same time. And so people tend to forget that these things repeat themselves. And so you knew at that time, if you follow the cycles, and my background more than finance in undergrad was economics. So I had a master's in economics, and I was watching the cycle and just saying, hey, you know what? We're doing a run up here. We're due for another churn. I had bought my first property back in '01. I sold it in '06. I sold it
Yeah.
in '06 because I said, hey, feels like we're toppy on the real estate markets. So I had some sort of premonition, but it's great. But you're in the ship and you think you're in a solid ship, right? You're looking out at everyone else. And you're like, when this crap, and I remember being at Lehman and I talked to one of the guys at Lehman, and I was in the London office. I was talking about, I speak a bit of Spanish. And I said, hey, maybe we'll go down to the Spain office. He goes, yes, we're going to be doing NPLs. Get ready, brush up on your Spanish, because once this credit crisis hits, we're going to do some NPLs in Spain. It's going to be great to go down there and clean up. And that was something we'd be doing in 2009, 2010. And internally, they knew, I think, some sort of cycle was around, but I don't think people realized how much that it could bring down as big of an institution as Lehman. I think it's like you're on the Titanic. You think that it's invincible, and you find that the choppy waters, and there's things below the surface that you didn't see.
Yeah. Amazing time. It's like one of those times, Sean, when you look back, it was like you remember where you were at that time. What were obviously you do. You were at Lehman, but I remember exactly where I was when Bear Stearns collapsed and Lehman, and just all hell was breaking loose.
Yeah.
It was
And by the way, I wasn't just in Lehman, I was in Lehman real estate, right? So if you want to
right
get the
in the
set,
middle of.
literally, I had access to the spreadsheet that shows up on the balance sheet for when they say, hey, I think it was like 36 billion. Like I knew those assets, right? Like I knew the London was 6 billion of that. And here's what this was. And I could figure out where, when it tracked back and we did the public figures, I could track that back down to some sort of spreadsheet that we were holding and saying, that's us, right? So it
Yeah.
was that close to it. And early, and this is like where we are today. So let's talk about the credit markets and what's happened, right? So this is quick takes. What am I seeing? And what are the things that I'm going, ooh, we had this earlier. We had this whole thing with SVB. I think we
Mm-hmm.
have this now. We're talking about real estate credit on the bank, regional banks. I have a view, and it's fundamental. It's somewhat factual. If you just looked at it and you said, hey, we went from a really low interest rate environment where we did a lot of loans, that 2000 period,
Yep.
and we have a bunch of stuff. So if you could look at the residential market, you go, hey, you have a whole bunch of loans on the bank's balance sheets that are 2.5%, 3%, sub four. Okay, they're 30-year mortgages. If you mark to market those just on a duration risk, what is that? Is that 40% down? It just quick math, right? So, how big is the US residential market? So if you've got how many trillions sitting out there and you just discounted it, did very quickly and said, if somebody had to buy all those today, what is it worth? And you mark to market it, that's pretty heavy hit, right? And so nobody's marked to market those, I don't think. That would cause probably a semi collapse of the financial system. And then you go and look and you say, okay, what about all the commercial real estate? I think I think it's still an issue. I don't think the banks have taken as much of it as a hit as they should. But I think also you talk about it and you say, wait a second, you just go back to the Lehman book and goes, Lehman's book at the end, I think they worked it out and got all the money back. So it was a
Yeah.
time issue, right? There was an illiquidity issue. Lehman didn't finance itself, right? So it was too short term. It had long term assets and short term liabilities. Probably not a great position. But you go back and say, hey, they worked it out over time. And so are the banks doing the right thing today and saying, hey, you know what, we're not going to take the hit, we're not going to sell these office loans and retail loans at a massive discount, we're just going to work it out over time. And by the way, the Fed will drop rates eventually, this will come back. Are they doing the right thing? Because today would be the time you should be buying it. So I think that's one thing on the real estate side. And I think today, looking at the credit markets, I think people forget that real estate is a portion of the credit markets, right? It's not I don't even know that it's a majority. And you go talk about the private credit markets beyond just the bank credit markets, the public credit markets, but really the private credit markets. You've got consumer, you've got auto, you have a lot of other
Yep.
things in there. And I think a lot of people are very focused on the real estate. So everybody, if you ask somebody, they'll say, yeah, the banks have these real estate commercial loans, and that's an issue. they don't really think about the residential portion because there's the defaults aren't up there, right? The defaults are still low because the rates are so low. But if you did the mark to market and you really dug down, I think people would start saying, hey, there's a real issue here, right?
Yeah.
If you have to mark to market, if you have to liquidate, if you liquidated a bank today and you did the sum of the parts and you mark to market it, what would it look like? And I go, probably not great. Can they
Yeah.
ride through it and get to the point where, they'll be fine? Probably. But if you have to market it, it's probably not good news. And so now what we're seeing is, and this kind of reminds me back of '07, is everything's fine, right? If you go back, and I love doing this, I think this is a fun exercise for anybody in the private markets, public markets, anybody who's an investor to do. If you think you understand the markets and you think you're able to predict the markets, go back, look up news articles from 2006, 2007, and 2008. Pick a topic, read the news article. I did it a little bit this morning. I've done it over the years. I always look back because you read the news today and you're reading it without knowing what's going to happen next. You don't
Right.
know if people are saying is accurate, right? Jamie Dimon is taking one view on it. Blue Owls guys are taking another view on it, right? Where are cracks in the credit market? How big are they? Right now we're predicting, right?
Yeah.
Go back to '06. Read what the top analyst, the top journalist were saying in '06 and '07. And you'll start seeing things that you'll go, oh, that wasn't true, right? There weren't that many people in the market, even up to '08. You go read articles in January of '08, and it goes, hey, we're almost out of it. Good news, all that bad stuff is behind us. We're ready to get back at it. You go look at the real estate markets. And I remember reading an article about the New York real estate market in '08 about people lining up for open houses. And so if you could pick a horrible time to
Yeah.
buy, it's probably '08, and people are lining up to get into open houses, right? So I think, what that tells me is that the markets react much slower than people think they do. People think about it as a point in time. Back in '07, we all of a sudden decided it was crisis. Everybody knew, decided it was a crisis, sold everything, and things collapsed by '08. It's not really how it happened. And I think today, what we're seeing and looking at is a little bit of that. And I don't know where we're going. And I don't think anybody, and this again, go back and read the articles. I don't think
Mm.
anybody knows where we're going. I think what people are seeing is, hey, wait a second. And this is why you see the sudden movement, right? Like it's a small blip, right? So somebody will have, hey, there was some fraud there. And everybody goes,
Yeah.
oh man, that's bad news. But when you actually take that one bit of loss and you compare it to the stock market loss, there's a far greater reaction proportional in the markets than the actual loss. So the markets aren't reacting, in my opinion, to that issue. The markets are reacting and they're jittery because they're going, wait a second. If there's fraud on one, it means that the underwriting was such that they missed the fraud. And if they missed that fraud, or it was so poorly underwritten that you missed a fraud, what else did you miss? What else is in there? And you
Yeah.
have a crisis of confidence of what's on those books. And now you're starting to pick and you're going, okay, is this an industry wide thing? Are we quickly going to go and say, hey, you know what? That's it. This is all. Boy, glad we have that behind us. Those were the two incidents and there's nothing else out there. Or is what the market's saying is, hey, wait a second. I'm seeing something more systematic that there was overexuberance in the credit markets before, lent where we shouldn't. And now we're going to see losses across many sectors. And I don't know where it's going to stop. I think there's an endpoint, right? I don't think it's overreacting in the sense that
Yeah.
you're not seeing banks collapse overnight. But I do think that people are starting to ask questions about what else might be out there. And so then what I expect will happen is now that you've seen one cockroach, now you're going to take that flashlight and look behind the refrigerator, right? You're going to look under the sink. You're going to start seeing, because it wasn't just one, now we've got an issue, right? And how big of an issue is it? And so I
Yeah.
think what's going to happen is over the next couple of weeks, you'll start seeing, the next couple of months, you'll start seeing a few more of these pop up.
Okay.
And then you're going to find, was it isolated? Was it an isolated incident? Was it several incidents? Or are there major issues with the way that some of these firms were underwriting credit that are going to show up across the board?
Yeah, Sean, that's fantastic. I was going to ask you, who knew Cockroaches was going to make such big news? And it's interesting because Blue Owl, other people are like, it's just Diamond fear mongering. It sounds like you're more on the side of Jamie Dimon. There's more cockroaches out there. It goes along with that saying, when the tide goes out, where are all the other dead bodies, right? You get them exposed. So you're on the side where there probably will be more cockroaches out there and kind of.
I think so. And I think we're seeing things. I don't think you're seeing like, so we talk, I try to post on items I'm seeing, right? So I see something and I go, hey, this is interesting. I don't know if the market's paying attention. I haven't seen it in the news. I'm trying not just to react to the news as in that one, but also call out things that I'm going, hey, wait a second, this hasn't made it to news. So if you go back and you look and at '07, you say, okay, what was the issues were in subprime? I don't think we have that same prevalent issues today in the residential mortgage markets. And again, that's not my specialty, but I don't,
Yeah.
my gut sense says it's not there. But we still have a subprime market. It's called non-QM. And if you go back and look over the last 2 years, S&P did a report and it said, hey, the DSCR lending, which is one part of non-QM, and I think non-QM lending in general, it saw a doubling of defaults over the past 2 years. Now, maybe it went from 2% to 5%, right? But it's a doubling and it's there and there's real issues. And then you go and you say, okay, and this is one of the things we think about. Defaults. Are defaults bad? People go, of course defaults are bad. That sounds like a bad thing. Yes, but how bad are defaults, right? It goes back to your recovery, right? So if you have 100% default and 100% recovery, that's an NPL fund. That's a great NPL fund, right? That's an amazing NPL fund, right? But the question is, what are the recoveries out there? And when you start seeing things like fraud, the issue isn't that there was a default. The issue is the recovery is zero. And I don't know what it's going to be, but that's what people are worried about. And so I think with some of these defaults that you're starting to see maybe in the non-QM, and this is in the real estate sector, the question is, and then you had another article in Bloomberg come out about issues of appraisal fraud in Baltimore, right? And so that came out. And so then you go, okay, I've got rising default. So that's known, right? That's a fact. I've seen an issue that some of these were underwritten with appraisals that weren't reflective of the actual value. Well, what is the value? Was it 50% greater? Is it,
Yep.
so if there's alt, is it a 50% loss? How much does it cost to work out? Are people going to declare bankruptcy? How long is this? I don't know. And so now they've got all these uncertainties. So I think what people are digesting, and they will be digesting over the next month or two, is okay, we have some facts, right? There are some facts. There are rising. And if you go look at the auto delinquency market, if you look at the auto loan market, or if you look at the consumer market, you're going to see in a credit card market, I think you're seeing rising defaults. That's fact, right? People can see that. That's on there. Okay, what you don't know yet, because it hasn't been decided, is what are the recoveries on those and what is the trend? So if you have rising defaults, does it rise and it goes from 2% to 5% within this small market, within the residential market? Or does what happened in 2007 happen, which is we had these things and everybody's like, that's subprime. It's just that little, that's what was really the thing is if you go back to '06, '07, when you first saw the first crack, you were like, yeah, but that's not that little corner over there that like, I'm here, right? Like I'm over here and that's that little corner
It
over
can't
here. It
reach
doesn't,
me. It can't
right?
reach me.
Right. Can't reach me right now. FHA defaults on like FHA loans, the fact that's rising, that's way over there, right? Like I'm in CMBS. We're completely different, right? He goes, or is that reflective, that little corner, the first corner that's showing, hey, so that the underwriting standards from this period of time, right? And we can talk about vintages. And I think you go back and do that. And Ethan Penner had a good podcast on it. He's another guy that I think you should get on. One of my bosses when I came back to the US and a legend of the CMBS industry. And he talks about vintages, CMBS vintages. Oh, you certainly don't want to be in this vintage. And I think there's going to be some of that, right? Was there a period of time when underwriting was poor? Don't wipe away the industry, just wipe away that time period when there was too much liquidity and then the loans reflected that. So that's talking about the vintage. But I do think that people are starting to look and saying, hey, is there something more systematic here than just an isolated incident, right? And so let's line up the facts of there are rising defaults. Compare that to, hey, wait a second, there's a lot of other things that look pretty strong in the economy. But you go back, the '06 economy looked great, right? Oh
Yeah.
six, he's still oh seven. Even oh eight, people were saying, you know what, it's not so bad. We're going to get through it. So there's some great articles written in January oh eight that you want to go back and read. And you're like, oh man, wish you could take those back. You were still closing. You go back to
Yeah.
oh seven. When I was at Lehman, we still closed one of the largest transactions in Europe in oh seven. And some of the largest transactions closed in oh seven. So even though the credit crisis was starting, and you could start seeing cracks in probably late oh six, right? But late oh six, you were starting to see the real estate market soften. I remember that for sure because I sold my place in oh six. I had my place and I told the real estate agent, we're going to sell it filings basement style. Like you put it up for what you think the market was,
Yep.
and they marked it. And I said, every week it doesn't sell. You have an open house, it doesn't sell, you drop it. Just drop it by 5% till we meet the market. A big fan of mark to market. Just let's figure out, right? Let the market determine what the price is. I'm not going to hang it out there. Let's get it. And we hit the market and it doubled in value from oh 01 to oh 06, right? And
Yep.
you're like, that's fine. Take your gains, walk away. But it was, I think it dropped, from there watching it sell. But I saw the market weakening because the
Yeah.
real estate broker was like, here's your comps. And, where I sold it relative to the comps, you could see that it was already collapsed. I
Yeah.
wouldn't say it was collapsing. You could already
Right.
see that it was a weakened market. And that was in late oh six. And that was just the underlying real estate market. And then you go beyond that, the credit markets that are backing that, they start showing cracks in oh seven. Kind of makes
Yep.
sense, right? So yeah, where we are today is we're starting to see some cracks on the credit market. Where does
Yeah.
it go from here? We're very early innings.
Yeah. No, I completely agree. And it's interesting you brought up 2006, 7, 8. You saw those cracks, but when markets are climbing, equities are climbing higher, it tends to hide those cracks better, right? Everyone's happy. Oh, S&P is up whatever 8%, 9%, everything's fine because a lot of people look at equities. It can mask a lot of the boogeymen out there for Halloween. It can mask a lot of the events out there, those cracks that are forming. And it could be masking that now because equities continue to climb higher. They keep reaching highs, new highs. And but labor market, there's some cracks. There's some other cracks in the economic side, and you're talking about the credit side too. So there's some things happening out there that, like you said, maybe it's a good time to take a step back and reevaluate things based on all the news that is out there. Like you're saying, the double in defaults.
Yeah, and I think and people think that these happen. I think things happen gradually and then they happen very quick. And I think what people are watching now is that ground shifting underneath that's leading to some things that are going to happen very quickly, right? You're just seeing those cracks. Is there a tectonic plate's going to pull apart at some point? And I think where you start seeing it boots on the ground, right? So I operate at two different sides, right? So I'm looking in the news and I'm talking to people in the credit markets that are kind of the Wall Street side, but we run a lending business, right? We're lending to real estate developers in the greater Boston area, right? So where do you start seeing the overexuberance in the credit markets on the ground? And where do you start seeing that cooling off in the cracks? And
Yep.
so, for example, why are defaults are low? You have to ask, are the defaults low because the market is really healthy, or is there an overexuberance that's hiding the cracks? And where does that happen on it? So you'll go and look at a project and you'll say, hey, if a developer is struggling and the markets are overexuberant, they'll be able to find another lender to take them out because there's tons of credit flowing into the space. And there's bound to be that marginal lender that comes into Boston from San Francisco and doesn't know what they're doing and takes that struggling developer out of their
Mm-hmm.
problem, refinances them, gives them another interest reserve for 12 months and lets them ride it out. And so what happens? Something would have been a default, right, last year, but somebody refinanced them out of that problem. So it doesn't show up as the defaults.
Yep.
And so then what happens is you get to a point, and then why do all of a sudden defaults spike? Is because next year, that guy, there's no takeout. And all of a sudden you get to the point where the markets, the overexuberance stops. Everybody gets more cautious. And then all these defaults show up because there's no takeout. And so I think in our own business, we're getting a lot more cautious. We're saying, hey, we're seeing this. We think that fundamentally there are cycles. I'm not great. And I don't think anybody, again, go back and read the articles from oh 06, 07, and oh 08, is great at predicting exactly when and how a crisis starts, right? And what
Yep.
follows on. But I think we feel that the market is not going to be as strong as it was last year. And I think that the credit markets are starting to show some cracks. Therefore, let us be cautious. And when we set up this business, we're focused on the capital preservation side. So we're senior debt in the capital stack. That's great for capital preservation. We're short term, right? So let's
Yep.
get rid of the duration risk. And we're yield focused as well, right? We want to generate income. But really looking from today from the capital preservation standpoint. And then we have a little bit of back leverage, right? You have operational leverage. We'll lower that, right? Go down from, I think we're at some points in time, maybe 40% back leverage. And if you look at the public REIT, some of them are like 80, 90, right? Or half of that. I think now we're trying to get down to 15%, right? True, just operational leverage we could pay off in a couple of months if we need to. So really positioning ourselves for, hey, if this cycle is going to turn, let's make sure that we're on the right side of it, because coming out of it, you really get to capitalize on some opportunities. I think that's what you look at and say, hey, it swings too far one way and it swings too far the other way. Let's make sure that we're well
Yeah.
positioned however the market moves.
Yeah. You're exactly correct. And I look back at great financial crisis and then more recently the pandemic, and I talk a lot about and write a lot about normalization. And back then, interest rates were at zero following on overseas negative following COVID. They were very low during following the great financial crisis. Then all of a sudden, the Fed increased rates at the quickest pace ever following COVID to fight inflation. That stuff's not normal, right? And especially during those really low interest rates. Now is a lot of people took advantage of that. Maybe we didn't take enough advantage of it. Interest rates at zero, but are now people starting to realize, okay, now we got to pay the piper now, and interest rates now we're looking to stay around 4%, and it's coming due. And now that's causing a lot of these cracks that you're seeing in credit, some of the jitters in credit, because now we're getting back to normal, and we're no longer, money costs something now. It's no longer
Yeah,
free.
that's it. And I think that adjustment period, right? We haven't seen it. Everybody goes, "Hey, we raise rates and look, everything's okay." Is everything okay, or is it just not showing up yet? And I think the answer is, I don't know if we know, right? I don't know if we know that the market adjusted well to the rate increase. It looked like it did, but maybe there's just a delayed reaction. And I think that's what we're starting to see now and starting to talk about is, hey, maybe there's more of a delayed reaction here than expected. And I think people, especially if you're looking in the public markets and you look at the private markets, one of the things is the private markets take a lot longer to react. And I don't mean that's react in terms of individuals, but it's not daily it's not minute by minute feedback like the stock market is.
Yeah.
And so I think some of those things are taking longer to adjust and work their way through. I think individual consumers take a long time to adjust when you're moving your rates up. You raise rates, but the mortgage rates moved. They're
Yeah.
6+ right? But everybody's, what percentage of the market is still on their sub 3% rate?
Yeah.
So it didn't change for that individual consumer that's locked in. And now you have this dichotomy of where if you want to borrow today versus if you already have a locked in mortgage, it's really playing around with it with the housing market, right? Because
Yeah.
people don't want to sell because what's the value of your home? I got this 3% mortgage. Like I'm never moving. I can't because I can't even downsize. You can't
Yeah.
downsize because you'll downsize your home and upsize your mortgage payment. You're like, it makes
That
no
doesn't
sense. I
make
can't
sense.
move. Like, how is it screwing up the labor market? Hey, lost my job in such and such a place. Normally I'd sell my home and move to where getting my new job, but can't afford to sell my house because my mortgage payment is going to move by this, or my rents, right? I'm going to be renting. I've got this. And so I think there's all these things that are messing around because that period of time where it was unsustainable. Why did I think people acted as if that was going to last for a lot longer than it did. And I don't blame the consumer for borrowing at
Yeah.
2.5%. But you go and look at a bank and you go, why did you issue mortgages at 2.5%? Because I could sell it to somebody. Okay, somebody's buying it. Why were they buying it? Because I have this money being
Yeah.
pumped in. I need to buy something. And I was like, I don't know if you should lock in for buying a 30-year mortgage at 2.5% or 3%. I think that was dumb, right? I know maybe somebody who's on a credit market was like, no, but I've perfectly hedged it. It's all okay. I'm missing the math there, but it's not my market. But just like from a macro perspective, that couldn't have lasted, could it? How? Did we have a prediction back in '01 that we were going to go Japan, or was that the view that rates were just going to stay low forever, and or was it we're now Europe, low growth,
Yeah.
low rates, and that was our future? And so maybe the 2.5% mortgages were great compared to the 1.5% mortgages they'd be doing 3 years later. Was that the view? I don't know, but maybe
Yeah.
we should have waited.
Yeah. Nobody, it was unprecedented. It was an unprecedented time. And now, we're crazy thing. 5 years later, and now it's like, now it's like you said, it's starting to trickle through. There's this transition period of going from something that wasn't normal to something that we're getting a little bit, inflation's normalizing, rates are normalizing, but now we're trickling through. And are we seeing the repercussions of that period of time that wasn't normal? And like you said, I think we don't know yet. We don't know yet.
And I'm very interested to see how the next couple of weeks will play out. I think what you're going to see is on these private credit markets, how it works is the private lenders, this is private credit shops, make the loans. A lot of them have back leverage it from the banks. And so I think that's what you're seeing where this discussion between Blue Owl and Jamie Dimon is, okay, who made the loan and who did the back leverage? And so the banks are making some of these loans, right? And there's that they're competing against private credit shops. But then the banks are also lending to the private credit shops
Yeah.
that are making these loans. And who's taking the bigger hit? Is it the private credit shop that has, yeah, they're taking a hit because they're losing all their, but that's a small amount compared to the back leverage. And how levered are these structures? And this is what we're talking about. We had a great session of the panel, and I said, hey, I want to be senior debt, and I want to be senior debt on real estate because I've got a real asset at the end of it. And this is exactly what I was talking about. This is exactly what I was talking about is if you're lending on something that can go to zero, it doesn't matter if you're senior debt or the equity, it went to zero. The
Yeah.
capital stack doesn't exist anymore. And I think that's what some of the jitters in the credit market are today. To bring it back is if are these guys lending on air, right? Whereas there's so many loans done on air where there's fraud involved or where the recoveries could be so low that not even the private credit shop that's making the loan, but also the bank that's behind them on the loan, the whole credit stack is wiped out and there's losses all about it, right?
Yeah.
Is that the issue? And so that's why I think some of the banks are taking the hit. Is not because they actually made the loan, but because they made the loan to the lender. And if there's nothing there, then the original lenders wiped out, but so is the bank taking a hit. And then if you multiply that and there's a lot more tricolors and first brand issues out there, then you have a real problem, right? And the banks have to go mark to market their books. The private credit shops are white, but maybe it's not as systematic, but except if what is systematic is the banking system that's behind all the private credit shops.
Yeah.
Uh,
It's interesting. Private credit. Let's focus on that real quick. Lastly, and it was on a huge wave of momentum following the great financial crisis, and everybody's talking about private credit still. They're talking about private credit. The retail side, they want private credit. Everyone wants private credit. You talked about some cracks in credit. There's jitters. What's your feeling on the health of private credit? Are we getting to a point where maybe interest rates now, like we said, they're 4% in that range of 4.25? Private credit, do you feel as if maybe we need to slow our roll with private credit a little bit? We are a little bit over our ski tips here.
and I think we need to segment it, right? And I get if you're in the private credit markets and you're a practitioner day to day, you'll start looking at it and you'll get, and again, putting content out there and I go, I'm really worried that somebody in the private credit market is going to blow up, just like we're talking about now. And all of a sudden, it's going to ripple through and affect everyone. And the reason is private credit is so vast. When we talk about private credit, are we talking about lending on consumers, right? Are we talking about securitizations, Klarna securitization, Taco securitizations, right? And is that buy now, pay now? Is that private credit? Is that what we're talking about? And you're comparing, or we're talking about real estate senior debt on
Yeah.
the other side. And where are we? And within that, I think there's some great operators, right? There are tons of great players in the real estate in the private credit markets overall that know what they're doing, proper
Mhm.
underwriting, have gone through several crises and are on top of it. There's also players, and I don't think that's defined by the size. I think if somebody goes and you talk to a wealth manager or you talk to an individual investor, they're assuming that these guys are a multi-billion-dollar shop. They must know what they're doing, right? And I go, that's not how it works.
Yeah.
There could be multi-billion-dollar shops that got a lot of money and threw it out in the markets because they got the money in, they had to put it out, and they put it out into something that they didn't know. They expanded beyond their area of expertise. So I think people are coordinate brand and credit security, and I don't think that's the case. So I think people need to segment that and then start looking. And then you segment it within each of those segments. You've got the guys that know what they're doing, the guys that don't know what they're doing. And I think we're going to find that there's probably, because so much money flew into the sector, that a lot of it went to people that didn't know what they were doing, or firms that used to know what they were doing, but now they got so much money in, they started doing something else, right? And they expanded beyond their area of expertise. And when I remember when I started out in the real estate private equity world, moving from the banking world, one of my investors, it was an endowment, head of an endowment, sat down with me and just said, stay in your lane. Like, all I ask is you stay in your lane, right? If you screw up and you stayed in your lane, I'm mad at me for my allocation. I'm not mad at you, because you did what you said you were going to do. And I asked you to play in this market because I wanted to be risk on in that market. But if you stray out of that lane and you say you're going to do something, and then you stray into an area where you don't have expertise because you think it's interesting for this, I'm going to be really mad. And then I'm not going to re-up, because that was a risk you took that I wasn't allowed to. And I think that's the same case now. I think there's so much money flowing into the private credit space, especially within the retail investors, probably the institutions as well, but really the retail investors, they don't know what they're doing. A retail investor doesn't know. They say, hey, I've got a brand name. I'm going to put money out there. I'm going to put it out. Blue Owl's out there. I'm going to get Blue Owl tons of cash, right? Where they're raising it. Do they know how it's underwritten? I don't. I certainly wouldn't. And so how did they know? And so then, and I'm calling them out because they're in the news. I don't have any particular information on them. But what I'm saying is that there are probably a lot of sectors within private credit that, because so much money is flowing into it, have gotten money that shouldn't have. It's funny. I can see the sun is rising here in the morning, and I'm just catching that glimmer right in my eyes that
No,
as the
that's
rest of my walking into the office.
yeah.
Uh, but anyway, so I think there will. So I think what I'd like investors to do and really sit down and think about is, don't just look at the brand names.
Yeah.
Look about where they are in the private credit market. Don't take a broad view of it. Really, you got to dig down, right? And if you aren't the person to do it and you don't think you can get it done, then this is where you go to the outsource, the OCIOs, right? And you get somebody within that sector and you say, hey, I need help.
Yep.
And I think, it's interesting. Once in a while, I get those calls from wealth managers that are allocating to real estate private credit. Right? And they'll call me and they'll say, hey, do you mind? I know, like, I've got a client that wants to allocate to this fund. This isn't my segment. Would you just mind taking a look at this and just letting me know what the risks are, right? Like, you can't give a recommendation on it, but can you just let me know if I'm
Yep.
missing anything, or do you know anything? And I think that's what really today, more than ever, when you are seeing these jitters, is I think wealth managers and allocators need to go and say, okay, I don't have the expertise to
Yep.
analyze this. I really need to either I need to fall back to things that I do know, but unfortunately, what are you falling back to? Is that the stock market and the public markets? I don't know that's any better, because certainly couldn't tell you whether today's stock market is justifiably. It looks overvalued, but what do I know about the growth of AI for the next decade, right? It's not my expertise, nor is it. Nobody really has 20 years of experience on AI, right? Like, it's just,
Yeah.
or the effects on the industry. But going back and asking, hey, what am I actually investing into? How do I know what is secured? Who are these guys that are underwriting it? Does the team have experience underwriting this, or is it a real estate team that's all of a sudden gotten into consumer? Is a consumer team that's already gotten into real estate, and that's just not their
Yeah.
segment. Having somebody to fall back on to ask the questions, to do that fundamental research, to discover where it is, because I think there's going to be a huge divergence within the private markets, within private credit, of the winners and losers.
Sean, that is spot on. Something I talk about more on the public side, knowing your investment, knowing what you're investing in. But on the private side, I often talk about private equity. It's amazing. It's just not private equities, too. And like you just say, with private credit, there are so many subsectors of it. And especially on the retail side, secondaries, venture capital, all these different subsectors that you need to understand. Let somebody who's a subject matter expert, a OCIO, work on it, because now that capital is more expensive, you really need to do your due diligence on this stuff. Do you have time, the expertise to do your due diligence? Probably not. It's a new space for the retail side. let someone else do it. So it's a great way to wrap this conversation up, because when you think about all the uncertainties out there, there's a lot of them. There's a lot of cracks, like you said. There's a lot of cockroaches. Make sure you're doing what's right for your clients and setting them up for success. So when that market does turn, you're ready to capture it.
Yeah, I agree. And I think what's fun, we talk about, we've had that, this all started with a LinkedIn post. And some of these LinkedIn posts I do, and then I ask, hey, who are the experts out there and what are you seeing in your market?
Yeah.
It's not the post that's interesting, it's the comment, it's the discussion. And so I did one on the DSCR market, so the non-QM lending markets. I did one on auctions, and the comments, tag the people that are the experts, bring them in, and the conversations you start seeing, you go, oh, wait a second, you're peeling back the onion in the conversations on there, because you can go back and look at, this person has been 20 years in this credit market, very specific, and they're saying, hey, there's an issue, then there's an issue, right? If it's somebody that says, hey, I'm just a novice, I'm 2 years out of school, and they're saying they're seeing issues, very different. And I think it's very interesting when you start seeing these comments and conversations and back and forth between industry experts in the comments. That's interesting. And I do the conversation generation it does, just like here, right? And I'm curious who else you're going to have back on to talk about the credit markets. You're going to say, hey, you know what? It's all okay. It's just fine. Right. Yeah, like, I
It's
don't know. Markets are
it,
overblown. Those cracks. That's it. First Brands, Tricolor. That was all that was there. That's all she
yeah.
wrote. Real estate markets, all that stuff is going to fix itself and we'll be back out of it. And the stock market is going up another 20%. And I'm all in. I'm waiting. I don't know. I want to see that guest out there. And I hope he's got tons of experience out there so that, look, bring in another view.
I
But
love it. I
we're
love it.
protecting
Exactly.
fence.
Earlier this year, it was the generational opportunity and credit. Is that still there? I don't know. Who
Yeah.
knows? We probably won't know for a while. But yes, I love these conversations. Markets, the economy markets are more complex than ever. That's why diversification, always boring just to talk about diversification, but it's important. These conversations are important. Sean, I can't thank you enough. Really fun. I love you connecting the dots between now, your time at Lehman, the great financial crisis. I think it's really important to look back, like you said, go back and read those news articles, see what they were saying, right? It's fantastic. Great stuff.
No, it's been great. Look forward to coming back on in a couple months' time,
Yes.
and we'll read the Bloomberg till then and see what the tickers
Yeah.
say.
Love it, Sean. Thank you so much. Where can our
All right.
audience get more information about RD Advisors?
So a couple things. So Sean Kelly Rand, you can follow me on LinkedIn. I do post all sorts of content there. And then RD Advisors, RE is our website, and we have a whole bunch of content on there. We've posted prior interviews that we've done. We've done some of our speaking slots, some of our presentations. So there's a lot of information there. There's a lot of information on our firm, but LinkedIn, online, and just shoot me an email.
Yeah. Awesome, Sean. Thank you again for coming on short notice, talking about this week on markets and just a broader view on things. I loved it. And thank you, everyone, for listening to this special episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on YouTube and Spotify. Please remember to like and subscribe those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.